Hey yo, what's good? It's your boy Dre Lasso here with some more crypto wisdom for your head top. So today I felt like for this Crypto Rants, we're gonna go back to the basics, take it back to the basics, because a lot of people's been asking me about the basics of crypto. You know, why is crypto so important? What makes Bitcoin valuable? How to buy crypto? How to send crypto? How to transfer crypto? So on and so forth. So let's take it back to the basics. So hopefully by now you understand what blockchain is. Blockchain is just literally digital ledger technology. So a ledger is just a list of transactions, just like a transaction sheet, right? So if you have a business, if you put money in the bank account, all of that is ledger. It's just a list of transactions being tracked, right? For a specific entity, business, bank account, so on and so forth, right? Now, the beauty of blockchain is that it's decentralized. So there's not one party that owns this thing or runs, the crypto network. It's a network, or think of it like a web, right? It's just a big web of computers that all share the same receipts. That receipt will be the blockchain. In particular for Bitcoin, it would be the Bitcoin blockchain. So they all share the receipts or the transaction history, the entire blockchain. So that means if one computer gets taken down, the network doesn't get taken down because there's many computers that share that same information, right? So that's pretty much how blockchain works. It's decentralized, it's permissionless. So blockchain is the first mechanism where two parties that don't know each other and possibly don't trust each other can interact and trade value, transfer value, so on and so forth, right? Bitcoin was created as digital money, pretty much digital currency, essentially. A lot of people aren't necessarily using their Bitcoin to purchase things, although you can now buy flights, you can buy goods, you can buy groceries, you can buy tons of different things. You can even buy a house with Bitcoin, right? Now that we're at where we're at in 2025. But before, you couldn't do any of that because people didn't trust it. So in that case, it ended up becoming a store of value. And the reason why it became a store of value is because a lot of its attributes and a lot of its characteristics are very similar to gold, and the fact that it's limited and scarce. Now, gold is scarce, but gold is not absolutely scarce, because we can still find mines, we can still dig and find gold because the world or the earth produces gold. So it's scarce to a certain amount, right? Bitcoin, on the other hand, is absolutely scarce, right? There will only ever be 21 million Bitcoin in existence, ever. 21 million is the cap. In the year 2140, that's supposedly or expected to be the last year when a Bitcoin will be created. And how are Bitcoins created? Bitcoins are created through mining. Just like gold. Gold is captured through mining. But in mining for gold, we're digging, we're drilling, we got big tools, so on and so forth. Of course, in Africa, Sierra Leone, and places like that where they dig for diamonds, they're doing this with their hands and very basic tools, right? Shout out to those people. My heart goes out to those people. But with cryptocurrency, or with Bitcoin, for instance, mining is used through computers. So there's these computers, they look like pretty much like your regular tower computer. It has a fan and everything to cool it down. It looks like a computer unit, a CPU, right? But these particular computers are pretty much solving transactions and looking at the digital ledger, that same digital ledger. So whatever computer can solve a transaction fast enough, whoever is the winner of that transaction being solved, they get rewarded in Bitcoin, right? Now, the beauty of Bitcoin is that this reward gets cut in half every 4 years. So last year was actually a Bitcoin halving year. So 2024, 2020, 2016, 2012, and then going back to 2008 when Bitcoin was created, the Genesis block. So every 4 years, that reward gets cut in half. And that makes the supply even more scarce, right? So scarcity is the real reason why Bitcoin's price has been going up. Bitcoin is a hedge against the government, it's a hedge against disasters, it's a hedge against inflation, it's a hedge against fiat currency. And fiat currency is pretty much the US dollar, euro. Any government issued currency is fiat. The word fiat is a Latin word. It derives from, Latin terms, and it pretty much means what will be, will be. So if I say that this is money, that means it's money, and it's backed by my guns and bombs, aka USA, right? So that's what fiat currency, but that's what fiat currency is. But the history of fiat currency, the they all at some point fail, right? They don't last forever. If you look back in history, every currency failed at some point. Most recently, currencies like in Venezuela failed. El Salvador was another situation, and now they have Bitcoin as their reserve currency. They even using US dollars as their currency as well to interact as well, right? So Bitcoin is scarce. It's a digital ledger technology. It uses blockchain technology. It's a shared network of computers, so you can't take Bitcoin down. This is why Bitcoin can't be hacked. So like, for instance, an exchange could be hacked, like, Binance or Coinbase or so on and so forth. Your wallet might be able to be hacked, but Bitcoin itself, that network can't be hacked because it's a secure network, right? So I hope you guys get that and understand that. And it's related to gold because it's scarce, there's mining, and now it's considered a store of value. So the fact that it's scarce is only ever going to be 21 million. People don't really want to sell their Bitcoin or get rid of their Bitcoin. Everyone just wants to store it and stockpile it. Hence the reason why prices are going up in Bitcoin, right? Now, this is very different from a lot of other cryptocurrencies, because a lot of cryptocurrencies like XRP, for instance, has billions of coins in its market or in its supply, in its circulating supply. So that makes the big difference. So a lot of coins, people think and assume that these coins are going to go up to what Bitcoin's price is, but it can't, because of the market supply and the fact that there's so circulating supply and the fact that it's so many coins out there, as well as the fact that it's a completely different coin. Bitcoin is digital currencies. There's different categories. You have your layer one contract, smart contract platforms like Ethereum, which is pretty much a developer platform where you can create apps or decentralized apps, what we call dApps, and create other tokens and other coins and whatnot. Then you have certain tokens that are focused on AI. You have certain tokens that are focused on supply chain management. So everything is different and not really considered like Bitcoin. So Bitcoin's mechanism, when we say mining, that is considered proof of work. Proof of work meaning that they show the work, and showing the work is solving those transactions, right? On the other hand, a cryptocurrency like Solana or Ethereum is proof of stake. So the way that they secure the network is by staking the cryptocurrency. Staking the currency pretty much means locking up your currency on that blockchain, which allows it to become stronger. And in doing that, you get a payout, kind of like getting dividends from your stocks, right? So that's the difference between proof of work and proof of stake. I'll dive into that a little bit more in another episode. We can focus strictly on proof of work and proof of stake and what the difference is, but those are the basics of what the difference is, right? Now, when it comes to cryptocurrency and storing your cryptocurrency, it's stored in a wallet, right? A digital wallet. So every exchange has a wallet. So whether you have your cryptocurrency on Coinbase, on Cash App, on Robinhood, on crypto.com, Gemini, Uphold, wherever you store that crypto, it's in a wallet, right? Now there's different forms of wallets, right? You got hot wallets and you got cold wallets. Hot wallets are wallets that are on the internet. And the reason that they're hot is because they're pretty spicy. Things could happen. They're subject to hacks. They're subject to different things that happen on the internet if you're not careful. Cold wallets, they're considered cold because they're not connected to the internet. They're separate from the internet. Those are physical devices that you can have in your hand physically. So think of like a USB drive, right? So that's a cold wallet. Now, the best wallet to have is a cold wallet because it's not attached to the internet. It's separated from the internet, right? Now, the wallet that exists on those exchanges like Coinbase, crypto.com, and so on and so forth, those wallets are cool, but those wallets are also not super secure because they own the keys to your cryptocurrency. And the keys is pretty much that seed phrase, the ultimate key to that cryptocurrency. So you don't own your cryptocurrency 100% when you have them on exchanges. Hence the reason why people say take it off the exchange and put it in a cold wallet or put it in a hot wallet. Now, when you get a wallet, when you open up a wallet, it gives you a seed, a seed phrase. Your seed phrase is like the ultimate password to get into your security lockbox, right? Think of it like that. So it's a 12-word phrase, sometimes a 6-word phrase, depending on the wallet that they give you. And if you ever lose your wallet, if you ever misplace that wallet, if you ever delete that wallet, you can always get back to your cryptocurrency with that seed phrase, right? That's the ultimate key to your cryptocurrency. Now, when you hold your cryptocurrency on these exchanges, they hold the keys. Hence the reason why you don't hold your cryptocurrency or own your cryptocurrency 100% when it's on those exchanges, right? And it can be subject to anything that happens. Like, for instance, FTX. People had their coins on FTX, and FTX went belly up, and then they lost their coins. And now they have to wait until they go through the court case to get their payout, right? Similar to Celsius, Nexo, BlockFi, and a lot of other platforms that went belly up and collapsed and failed, right? Now, that cold wallet is very secure because, again, it has a seed phrase. Now, you don't always have to put that seed phrase in every time you open up your wallet. That's only if you lose your wallet and you're trying to restore it back to the coins that you have, right? So in order to get into your wallet, you have like a general password. Each wallet will have a password where you get into that wallet, right? Now, in addition to that is your wallet address. So your wallet address is kind of like your email address. This is something that you can share with anybody, but there's a public address and the private address. Your public address is the one that you can share with people so that people can send you that cryptocurrency. Now, you can only send the same cryptocurrency to that same wallet. So, for instance, I can't send Ethereum to Bitcoin. I can't send Ethereum to Solana. I can send Solana to a Solana wallet. I can send Bitcoin to a Bitcoin wallet, Ethereum to an Ethereum wallet. Now, the beauty of Ethereum and Solana, like I said, these platforms are software platforms where you can build tokens and build coins. So there's a way that you can send coins that exist on those platforms to an Ethereum wallet. So coins like Compound, Maker, Polygon, there's tons of coins that were built on the on the Ethereum blockchain, which allows you to interact on that particular blockchain. But if it doesn't exist on that blockchain, you can't send that crypto. It would get lost in the ether. It would be lost in the labyrinth of cryptocurrency, just in crypto space, right? So that's how that works. Your public wallet address is the address that you can share, similar to an email address. Everybody can get that. I could post it up on social media. That's not a problem because that's a wallet for people to send me things. Your private address is something completely different, and that's something you should hold dearly and never share with anyone because they will get access to your coins. Now, how you can buy crypto? You can buy crypto on tons of different platforms. You got PayPal, you got Robinhood. E-Trade is about to start allowing crypto trading. You got Fidelity, Crypto.com. But the most popular one, the McDonald's of cryptocurrency, the Nike of cryptocurrency, is Coinbase. That is the biggest platform where you can buy cryptocurrency. Now, when it comes to those platforms, they do charge you a fee in order to interact and operate on those platforms. There's other platforms for more advanced traders like Blowfin, BitGet, and Gate.io, Binance, just to name a few, where it's a little more difficult, a little more advanced, but the fees are much lower. Now, if you want to trade and have no trace of your trading on a centralized platform, because Coinbase is centralized, even though they sell decentralized assets, it's a centralized platform because they have a CEO, which is Brian Armstrong, right? So Coinbase, Robinhood, all of those are centralized, traditional companies. Decentralized companies like your Uniswap, Aerodrome, SushiSwap, all those different platforms are decentralized platforms because they're built on a platform like Solana or Ethereum, and they allow you to interact. So instead of you spending your money from your bank account, from your debit card, from your credit card to buy cryptocurrency, you're trading crypto for crypto. So it's decentralized, right? So that's another way you can buy cryptocurrency, but that's more advanced as well. So if you were to download a wallet like Phantom Wallet, which is a Solana wallet, you can trade crypto for crypto, swap crypto for crypto on a decentralized platform. Now, a lot of coins, when they first come out, the majority of the time, or every time, you can purchase them on a decentralized platform, and it takes some time for them to get to a centralized platform. These coins have to be vetted before they can be available on a platform like Coinbase, crypto.com, so on and so forth. So they have to go through a vetting process because there's a lot of scams out there. There's a lot of rug pulls. A lot of people have been tricking people with these cryptocurrencies. Hence the reason why a lot of your coins are not available, specifically or especially in certain states. Like, for instance, New York is very stringent. There's a longer process. I'm losing words, but there's a longer process in regards to vetting these coins before you can be able to buy them. So other states like Georgia, so on and so forth, they allow you to buy a lot more cryptocurrencies because they're a lot more lenient and less strict when it comes to purchasing cryptocurrencies or allowing cryptocurrencies to be available. So the SEC is part of the security or the regulation for these cryptocurrencies. Hence the reason why we had court cases with Ripple, because they were saying that these coins are securities. A security is something like a stock. So that's part of the reason why some of these coins weren't available on Robinhood and so on and so forth at a certain point. But a lot of these coins pass the Howey test, which determines if a coin is a security or not. A lot of them pass the Howey test, which now allowed them to be available on Robinhood once again. But if you want to get those spicy coins, those really risky coins, you have to use certain platforms which are decentralized. Crypto.com is one of the very few platforms that has access to a lot of coins that Coinbase might have access to, because their vetting process is a lot more lenient, right? But in a nutshell, that's how you buy crypto. That's where you can get crypto from. How you can send crypto. You can send crypto to any wallet, to anyone, but it has to be that particular crypto or on that particular platform. So I can't send a coin that exists on Solana to a coin that exists on Sui, which is another smart contract layer 1 platform. But however, there are these protocols that build these what they call wormholes, or allow you to swap coins that might exist on a different platform on that particular platform. There's also something called wrapping, which happens on Ethereum, where they wrap it with the Ethereum protocol coding. So I can now trade Solana, but it's Solana on the Ethereum blockchain, right? So make sure when you're sending your cryptocurrencies, you're sending it to the right wallet address. Normally, if it's an Ethereum address, it will start with 0x. And it'll have a long list of words or letters and numbers and so on and so forth. But make sure you pay attention. Make sure before you send these coins, you actually look at what you're sending, copy and paste, and make sure you don't put any spaces, because then it will get sent to nowhere, right? So be very careful when you're sending cryptocurrency. Be very careful when you're buying cryptocurrency. When you're sending it to your wallet, be very careful as well. Now, on another episode, I'll dive in a little bit deeper and show some examples of sending coins, trading coins, and transferring coins. But that's it for this crypto rant. Be careful. Do your own research. Again, this is not financial advice. Tap in. Make sure you share, like, subscribe, tell a friend to tell a friend. Crypto Rants, Urban Blockchain. Your boy Dre Lasso. We out.